Hello everyone, and welcome to our Market Alert video for today, which is August 15, 2025. I am Ken Moray, the founder and CEO of Retirement Planners of America. Those of you who tune in, you know that I normally wear a jacket and a tie, but given the comments that I got from people that I was a little too stuffy with the button-down collar and the jacket and the tie and all that, I decided to go completely the opposite direction. So I'm wearing a shirt, what is this? A t-shirt this time, right? So what do you think? This is Jordan, our Chief Investment Officer. So what do you think?
I like it. Now, you didn't do the Submariner.
I need the Rolex to complete the look, yeah, but no, I don't have a Rolex.
And I know we have a nice quarter zip, and I'm going to start wearing that.
You're going to start wearing that? No,
I love the quarter zip.
This is a temporary thing, okay? I'm just doing this as a funny.
You don't need to make any decisions today. You don't need to make any decisions today.
Actually, it is pretty comfortable. I like it. This is a nice shirt. It's nice and soft. So let's talk about what people want to know, right? And that is that we got inflation data this week, and year on year it looked good. But then we got the PPI, which looked terrible, which is the producer price index, the cost of producing stuff. So kind of conflicting. Which one is the one we should go with? So we're going to talk about that. Brings up the topic of stagflation again. So let's talk about what that is, first of all, and then how that could, if stagflation really catches on, it could decimate the stock market, the bond market. And then for me, the one that I worry about is our economy has a cancer, and it's our national debt. And we crossed over $37 trillion this week. $37 trillion. And what does that mean for the future? So we have a lot to talk about today. So let's dive in. So let's start off with CPI, and the stocks went flying, the bonds went flying. Everybody was happy, because the consumer price index, consumer inflation year on year was down.
I mean, it is good news. When that came out, that is good news because, again, the thing we addressed every week is the market is waiting for inflation prints to come higher. And it keeps inching lower, keeps being in line with expectations. And it looks like, companies are using that profitability they have, that margin, just to absorb some of it, to keep people buying goods. And so very good news. We saw stocks and bonds go, right?
Yeah, and we had a big surge. I mean, the market was up over 1% that day, followed up by
bonds
another 0.5%.
Yes.
Bonds were up. So why would bonds be up if inflation is coming down? Why would bonds go up?
Maybe it's finally the data point, enough ammunition for the market to go, the Fed is going to pull rates down.
Okay. So now the expectation is the Fed's going to lower interest rates.
Over 90 right now, the market's pricing over 90% chance, which is basically one-way traffic. We're saying, you almost never see a 100% bet. But it's basically saying, we think Fed at the next meeting, which is September, they're going to start pulling rates down even more.
You know what I love right now is how the Trump administration, at least from my point of view, is negotiating with the Federal Reserve. Scott Bessent, the Treasury Secretary, comes out and says the Fed needs to drop interest rates 1.5%. But you know what they really want, right?
Anything more than zero is good. That's what they want. Something small.
Yeah, so now the Fed can say, we're not going to lower it 1.5%. We're only going to lower it by 0.25%. So there, Donald, you can't push us around, right? So he's giving them cover, I think.
I think he probably is. It's interesting. It's flowing through to the Treasury Secretary finally. We've heard it from the president enough. It's the first time that Bessent's been very vocal about it. So I would imagine the Fed is going to have to do something. Right, but it can't do a 1.5%. No, and I don't think we want that either.
Right, that would be if they did that. I think it'd have the opposite effect. Right,
so
everybody would panic. It's like, what the heck are they seeing that they have to cut interest rates that much by?
Right.
But again, I think this is because the Federal Reserve, they don't want to be seen as doing what Donald Trump tells them to do. So if he tells them 150 and they do a quarter, then you didn't tell me what to do. We're an independent body.
And
we will not be pushed around.
Win. That's right. I think you're probably right about that. Now, we'll see if PPI changed any of this.
Okay, let's talk about PPI. So tell us, first of all, what is that? What is PPI?
It's basically the producers or purchasers index where, companies that are buying raw goods to turn them into retail supplies and goods that we consume. It's what kind of inflation are they experiencing on raw materials? And we saw that jump a lot. Because
that's going to flow through into everything else, right?
That would be the fear, is that PPI a lot of times leads CPI. And so if you have that jumping up, then at some point, is it going to be passed on and flow through? Because I don't think, based on what that rose, if that's a consistent theme, I don't think companies can pass all that inflation back on. Absorb it all. They'd have to pass some of it back through.
Yeah, so this kind of leads into stagflation.
Which, in my view, quite frankly,
Well, first of all, let's talk about what is stagflation. Tell us what that
stagflation is a very unique event where you see inflation being sticky or going up at the same time growth is going down. And what that does is puts the economy and the Fed in a very big predicament because the tools they have at their disposal typically will affect one thing. You can work on one side of that equation, but the things that will help the economy typically could cause inflation to get worse. Typically, the things that would cause inflation to come down could also cause the other side to move the wrong way. So it's a very, very bad thing and something that we really haven't seen in the U.S. since the late 60s through early 80s.
And we had some severe bear markets in the 60s and the 80s.
It was, very bad. You had basically a 30+% correction bear market. You had a 45% correction. You had a 27%er. You had a 22%.
You had almost a 60%er in the late 60s into the 70s.
You had basically a period of over a decade where the market effectively went nowhere.
Yeah.
In absolute terms and in real terms, really went negative. So it is a very big problem.
And fortunately, we were able to manage our way out of it. But there are countries that were not able to do that, and it decimated their economies. And
they never returned from it.
And they never returned from it.
That's right.
So stagflation is way worse than inflation. It's a terrible thing because you have inflation and slowing growth happening.
It's worse than a recession.
Time.
Because a recession typically is deflationary.
Yeah.
So it's
so hopefully that won't happen. We don't give it a high probability of happening. But it certainly, if we do see inflation pick up, and we see growth falling at the same time, then that could be a bad combination.
Yes.
The thing that I don't know that I'd say I stay up at night thinking about, but it is beginning to get worrisome to me, and that is our national debt. We're at 30. We just crossed over $37 trillion this week. $37 trillion. That is just a mind. I can't even wrap my head around how much money that is. How do we? I don't think we can ever pay it back. I don't know how you do that.
No,
and
not.
When does the rest of the world say, "Hey, America, 38 trillion is your credit limit. We're not lending you any more money. We're done." And if that happens, we could have a significant seize up of the bond market. We could have a horrible recession. We could have a depression, for that matter.
Yeah, I mean that if the market really at some point said, "We're not playing your game. We're not lending to you anymore." I mean, we at that point, you are for the first time probably since the 1920s, early 1930s, talking using the word depression. I think that would seize everything up.
Yeah.
If the global market just said, "We don't want to lend to you, we don't want to play with you anymore, because we're going to call that you can't pay us back anymore."
Yeah. I mean, this is kind of like we're living in a theoretical world at this point.
We are pushing it, and I've been hearing it for my whole career of already people thinking this can't be possible, and every year. We just extend our credit facility and keep doing it, and people are still buying our debt. But at some point, you got to think that this ends.
I hearken back to one of my favorite philosophers, Richard Nixon.
Okay. Yep.
I think he was using, it wasn't his comment, it was one of his chief economists, but he said anything that can't go on forever won't.
That's pretty good.
Pretty wise words, right?
I'll tell you what, that is.
And I don't think this can go on forever, and therefore it won't. And when do we hit that wall? I don't know. But when we do, if we do, hopefully we won't. Hopefully we'll do something before that. But if we hit that wall, it could be significant. So for me, that is the greatest threat of all. I worry about that more than going to war with China or the inflation that we're experiencing now or stagflation or anything else. I think that long term is the single biggest threat we have in our country. And I feel, even though I do worry about the consequences of that if we do hit the wall, one thing I'm happy for is that we have a strategy, that worked in 2008, told us to get out in November of 2007 before the bond market froze, and we saw the stock market go down 57%, which I could say is depression level drop in the market.
Sure.
And we weathered that storm very well. Our strategy protected our clients. We didn't lose money in 2008. We didn't lose a penny.
Yes.
During that whole period. So what would you say to people who are not clients in terms of thinking about their retirement, what they should be, certainly they should be a client, but if they weren't a client, what would you say they should do?
Well, I think the trap that I think a lot of people can fall into is they look at a period of the world and think that those things are just always going to continue. And they base their future on kind of a very single outcome, right? Or a single set of trends that are going to persist for forever.
Recency bias, isn't it?
Recency bias, okay? We'll call it that. And so I think the trap they could fall into that could be very dangerous is not planning for all the what ifs, the contingencies, maybe the things that they have not experienced in their life but have happened before, whether it's in our economy or others. And so fortunately, we have a strategy that will defend against that. And fortunately, we don't necessarily have to predict when that's going to come in, right? I think that's the other thing is we're not predicting that this will happen. We just have a way to know that we have a line in the sand, rules-based scenario to react if that's actually unfolding.
So people shouldn't just buy and hold. They should have a line in the sand, as you call it. They should have a strategy where, you know what, I'm taking my marbles and going home, which is anti the whole buy and hold thing, right?
Yep.
And we've railed against it forever, that buy and hold is an incomplete strategy if you're over 50, if you're retired or retiring soon. You need to have a buy strategy for sure, a hold strategy for sure, but you should also have a sell strategy to protect yourself, as in Y2K, as in 2008, as in the next one. And, you know, I've been meeting with some people in their 50s, and one of the things that I get from them is, you know, it's been 17 years since the last big bad bear. And so I get the impression from them.
They think because of that it's not going to happen?
Yeah, exactly. That's old news, man. That's not going to happen ever again because it hasn't happened in the last 17 years. How do you respond to that one?
I would say if we take history as a guide, and I think most people should, right, that history always rhymes, right? There's rhythm there that repeats itself. Is once we start getting to this long of a timeline versus we had a massive reset, the next reset's going to come, and it probably is going to be bigger. Mm-hmm. If we go throughout history, and I just kind of go through things. I mean, I think one of the reasons 2000 was so bad is the market largely just ran from the early 80s all the way through.
Almost from 82 through 2000.
Right. We had, a couple blips along the way, but largely just ran rampant. If you look at, how bad it got when the late 60s, 70s, early 80s, is because coming out of World War II, kind of unblemished for a decade and a half, almost, 2 decades.
Yeah, so I guess maybe the history might even imply that the longer you go before the next big bad bear, the worse the next big bad bear might be. I kind of think of it as a rubber band, right? So you stretch the rubber band a little bit and you let go, and it doesn't really hurt that much. Yep. But if you stretch it out all the way to there and then you let it go, bam, it hurts.
I think that's fair.
And it's been 17 years since the last big bad bear. And to me, that doesn't imply that we're never going to have another one.
No, it would be the opposite to me.
Right.
Okay, let's even go to 08. Why 08? I mean, 08 was on the back of 2000, so then those were pretty close, which is very rare historically. But why was 08 so bad after we just experienced it? Well, it's because people forever assumed housing prices they've never gone down, and they was going to keep going up and up and up.
You can't lose money in real estate.
And so the longer that trend comes, the harder it reverses when it comes. And I think that's where we have a strategy. Hopefully, we'd love to not have to ever put it in place.
Yeah.
But I don't think I'd bet on that.
The question, ladies and gentlemen, that we ask in our seminars is, between now and the rest of your life, what do you think the odds are that there's going to be another big bad bear? And almost always the answer is 100% are the odds. So our question then becomes, if the odds are 100% that you think something's bad like that's going to happen, does it not make sense to build in a strategy into your retirement plan that addresses that? So our advice to you would be address it. Have a strategy to bail if bad times come to protect your retirement. And we have a strategy to do that. We call it Invest and Protect, but if you don't want to use ours, you should think about having one of your own. So thank you for joining us for the weekly market alert. Please like and subscribe. Also, make sure you go and check out all of our podcasts. We just had one on the dollar and what it's doing, and is it safe to assume the dollar is going to be the king of the hill for longer? We've done some on the tariffs. We've done some on estate planning. We've got all kinds of topics for your benefit. So go watch our podcasts. We've had over 1 million views, so make it 1,000,001. So thanks for watching. Hope this video finds you healthy, wealthy, and wise, and we'll talk soon. People are always asking me, we watch your market alert videos, we listen to your podcasts, and we want to get a hold of one of your retirement planners to help us to build our plan. And how would we do that? Well, you know what? It's simple. All you have to do is go to our website. It's rpoa.com. And when you're there, click on Meet with an Advisor. And if you do that, we'll build a plan for you at no charge or obligation. And if you like what you see and you want to work with us, that's fantastic. And if not, that's fine too. Either way, we will part friends. So take advantage of that. It's at rpoa.com.
Retirement Planners of America.